This is our Forex blog for March 17th, 2014. And like I said last week, um, our scripting language is in Visual Basic. The program is actually written in C++, and I am redoing our signals so that there's no limitations. I don't know if it's the number of lines of code, approximately 15,000, or the number of subroutines or variables, but I pretty much run out of room, so I'm reformulating our signals in C++. It should take me about a month and a half. My partner thinks it'll take a week or two only, but there'll be no limitation. I can make the signals 10 times bigger if I want to. But here's the signals today. Bought here, had a nice little win. Found this little mini double bottom right here, and the market was strong enough to support a buy. One of my secret indicators, which I might release in the future, measures the percentage of currencies above and below VWAP. This basically in a nutshell shows what percentage of every euro pair and dollar pair is above and below the balance point line, which is basically VWAP. This is where most traders have positions during the day, and so above that level it tends to go up, below that level it tends to go down, it tends to be choppy right near it, and you can see a really very small percentage of euro dollar pairs are weak and dollar pairs are strong. I have a nice little mini double bottom right here and caught that huge move up. I will also be in the next release, because I ran out of version of space right now. I'm going to put a lot more time and effort into using fib-based pullbacks and also fib-based time extensions. The real low is probably back here, and well, actually the low of the move up was right here. You can see the Fibonacci price or time extensions. Based on the time of the move up, typically the market, after it makes a big move like this, is going to need to pull back a little bit more. So I will be getting rid of some of these losses like this. This is a 38% pullback, so I would still be buying that one, which resulted in about a 5 pip loss. But the goal is to catch big wins and have small losses and have 50 to 75% winning trades most days. And when I rewrite this, I can put a lot more patterns that repeat over and over into these signals. Alright, so in the meantime, you can use our FX trade signals, but they also work a lot better when you use them in conjunction with our currency indexes. This shows what all the euro dollar pairs are doing. You can see it's underneath its hourly, it's underneath last week's most traded price, so it's more likely to go down. We also have, with the yellow line on here, VWAP for all the euro pairs. So underneath VWAP it tends to go down, above it tends to go up. Notice how it gets you short right here early into this move. The market's kind of going sideways. Usually the first moves of the day tend to be big ones. And you can also see it went back above VWAP at 9, pulled back and touched it, acted as support here and here. This is a real number. Currencies, when they're weak, tend to stay underneath it all day. They never get back above it, as you can see. So basically, in a nutshell, you want to buy the strong currencies versus the weak. All of these are weak at some point of the day. Let's look at some of the other currencies. The Australian is strong, the New Zealand is strong, the CAD is strong. Notice the CAD went from underneath to above its hourly moving average. Same thing with VWAP, and same thing with the hourly or the 15-minute green moving average, all at the same time, right at 3 o'clock. The Australian and New Zealand are already strong. So the dollar's weak, you can look for buys in the Australian dollar, New Zealand dollar, and also sells in dollar CAD once the CAD got strong. So you can see this one broke out. You have a nice little multi-hour rectangle pattern right here. You buy the breakout. Typically it's going to go to the fib target of this move, which is up here more than likely. Let me just draw that on the chart to see. And the key to trading is small losses, big wins. And when you're using a currency index, it's just like you can visually eyeball where the fib targets are. Hit the first one for many hours, couldn't get above it, and then broke out and hit the second one. Now, if you want to do counter trend, one of the better ways of doing that is looking for double tops or double bottoms, especially when they're at fib targets. Very high probability. Now this one didn't pull back that much, but this is a pretty low risk trade. Let's take a look at the New Zealand dollar. Again, same thing. The New Zealand was strong, the dollar was weak. You have this little rectangle pattern right here. You buy that breakout, you put your stop underneath here, and this one went your way, came back, and it's going sideways again. You move your stop from underneath here to here, and then it just, kind of works its way up. You don't know that this might be the end of the move, so you might want to exit half your trade, or at the very least, if it pulls back a little bit, yank your stop up here. And from that point, typically it's going to run out of steam. And again, look what happened here. Double top. This one's extremely high up. In fact, if you hit the fib targets off of this first wave right here, more than likely it stopped right at the fib targets. Look. So it went up, sideways, up, third wave up, double top right here, and you can see in this case it pulled back about 15 pips from the high. So use fib targets, use our currency indexes. They really do make trading easier. And another thing you can do, there's hundreds of ways of trading with the currency indexes. When you spot a trend that's down after a pullback, especially if it's at the upper perfect oscillator level or even the upper Bollinger Band area, these are pretty decent places to sell. In some cases, and as you can see here, hit the upper Bollinger and then it kind of drifted up slowly, but the band is above it, as you can see here. That's, a pullback right to VWAP with momentum slowing. It's a very mild pullback. So there's, those are some of the best trades possible. When you get a nice pullback that doesn't have that much statistical intensity to it, when it breaks the low here, you get short. So let's take a look at that one. The yen's weak. It has a pullback. My favorite trades are pullbacks, because especially in the middle of the range, because if it goes and works its way down to the lower bands, which most of the time price does not get outside of the bands, maybe 1 out of 5 days it does. The rest of the time it hits these bands and either goes sideways or pulls or reverses violently, like you see here with the pound. So let's take a look at this one here. We want to find a strong currency. The dollar's just going sideways. The euro's weak. The pound's strong at that time. You could take a trade in the pound yen, looking for a buy in the pound yen, coming up to 4 o'clock. So let's take a look at this chart here. And this is how you can use the currency indexes to anticipate future price direction. Coming up to 4 o'clock, you can see that this one clearly made a higher high. It actually pulled back to its previous swing, which is a phenomenal trade in and of itself. It also very likely is a fib pullback area from this whole move. That's probably 38%. This is probably the 50, the 62% pullback. And it also, kind of was in a nice little range here, broke out, pulled back, went sideways, holding support, the 38% fib. You could go long right here once it goes above these bars high with your stop underneath here. And the key to trading is just small losses and bigger wins. So you're never going to catch every pip, but even if you got out right here, when it pulled back, you can see that this is 3 to 3.5 times bigger than what your risk is. You made 10, 20, 30 pips on this while risking less than 10. And what's nice about this also is your initial risk, once it goes your way, especially once it's up 8 to 10 pips, you should cut it in half. So if it did come back and stop you out, you lose literally 4 to 6.5 pips. So on wins, infrequently you're going to have break even or very small losses, smaller than what your initial risk is. That's the key to trading. So let's look at one that didn't really pan out. This, we'll draw the fibs on this. It's always good to have a reference for where the fibs are, both from the last move and the last couple of moves. Where they intersect is called a fib cluster. So the 62% retracement of this last move aligns with the 38% retracement of the bigger move, which was a 66 pip move. So that's a pretty decent fib cluster based place to buy, especially when it pulled back. It's really near the 1.0 time extension of the move up here. So it had plenty of time to pull back, and it didn't go below the 38% of the entire move. Very mild pullback. You go long right here with your stop, and guess what? This is your initial risk, and so this starts to go your way. You move your stop in half, and when it can't get above the 60 or 38% retracement on the way back up, it tends to be in the chop zone. A lot of times when they don't bust through here, the move's over. So you could always exit half with 15 to 20 pips, move your stop to break even, And if you get stopped out at break even here, or if you're manually trading and you're watching it, you know, when it comes back down and should have stopped you out and starts to go back up and can't bust out the second time. This had 2 chances to go up, 1, 2, and it, you know, couldn't even get back up to the high. So you got to get out. You might have made 5 or 6 pips on the second half and 15 to 20 on the first, even if it with a trade here that didn't work. So if you did, let's say you got, you know, the entire amount on the first half and broke even on the second half, your average win is probably somewhere like this. Your win is approximately what your initial risk was. And if you compare that to what it very quickly became, half risk, you made 2 times your half risk or 1 times your full risk on that trade, and it didn't even pan out. So the next place to possibly look at getting in is a 50% retracement. If you got in right here with a very, very tiny stop, you can see it came back up, hit the 38% retracement, same as before. Couldn't get above it. If you want to exit half and get stopped out of the second half, you get in the third time, and that's the one that took off. You know, you get out of your first trade here with 15 pips, move your stop underneath here, and then it just takes off, and you had a home run on that. So if you got out of your second half here, your first half somewhere in this area, your average profit on the second trade is probably somewhere like this. So you can see the risk reward on that trade is 3 or 4 times bigger than what your risk is. And again, that's the key to trading. It's the only key to trading. And when you use our trading signals, the same thing applies. Using the currency indexes, which you can show and hide on a layer, look at any time you want, see which currencies are strong, which ones are weak, focus on the right currencies, draw your fibs, draw trend lines, whatever you need to do, you know, to find these high probability trades. And by the way, you know, trend lines work phenomenal as well, especially, you know, when you get a pullback, comes back up, you can draw your trend line on this. But guess what? The meat of that move happened when the trend line got broke. And let's zoom out a little bit, see what we have from trend lines off the lows. You know, that's where it kind of found support right around that trend line from before. So you had a strong pound, a weak yen. You know, the trend line is a great place to be getting in. This one hit 1, 2, 3 times. This is the 4th time. If it doesn't, you know, find support here, let's say you bought it and it starts to go back up and fails, you can flip and go short and probably get your loss back plus, you know, 2 times your loss quickly. When trend lines break, there's big moves. You can also use our trend channels for a very high probability exit place of your trends as well. Hold on a second. Draw these trend channels, and all they are is taking the trend line and projecting off, you know, the highs. And look where the market kind of ran out of steam. And it frequently does. You'll see this over and over again. Right in the upper quadrant. And here you have a double top where it hits the 3/4 line. You know, very high probability place. And if you use our statistical tools, you'll probably find divergence in strength, whether it's the FX power index that shows you what percentage of currencies are above their moving averages at different points. This will come in a minute. You can clearly see the percentage of currencies trending up was very high here, much less right here, and pretty much similar right there. It wasn't off the chart. You know, not every pound pair was going up and yen pair was going down right here as they were, you know, at this move. So when you see, you know, super strength like that, no matter what statistical tool that you decide to use in our software, you can use them to spot reversals. You know, one of them that many traders use is the Fisher oscillator. It does a good job of finding reversals. The perfect oscillator does too, actually. Let's put that up here. So this was at the plus 80 level, which typically is what causes reversals. Right around here, it's at an extreme. And as the market's kind of going up slightly, you can actually see the perfect oscillator is kind of falling. It's actually goes below the moving average of the perfect oscillator, which is a great trade, and it symbolizes that the upwards momentum is rapidly decelerating. So you have a double top with rapidly decelerating trend strength, great place to go short. Again, there's literally hundreds of ways to trade using our statistical tools. But also, if you notice, when you hit key areas like a trend line or fib area, if the perfect oscillator is at the -80 or even hitting the lower Bollinger Band, it's a much higher probability, place to get in, especially when it comes down rapidly like this and bounces off of it. As this is going sideways, you can see the perfect oscillator is actually going back up. It's a very fast tool that doesn't suffer from drop-offs. It doesn't use 14 bars or 10 bars or 50 bars or 100 bars or 1 bar or 5 bar. It uses statistics for that time of the day to see how far away the market is from very fast digital signal processing based moving averages, comparing it to that time of the day in the past. What's the farthest prices ever in the last 20 days been away from that fast digital signal processing based moving average? So when it hits 80, it's basically telling you that price is 80% of the distance of the farthest away it's ever been in the last 20 days. That's a very key reversal area. And especially when you have a trend that's up, buying at the, when the price is at the, or near the -80 level, you might have a loss here and then you get the loss back on the next one. Notice this trade right here, which didn't pan out, but the price did reverse off of it. And notice the slightly higher high here with divergence in the perfect oscillator. That's saying the price is going higher, but momentum is rapidly decelerating. You see the exact same thing happening here. So perfect oscillator is a wonderful tool. I call it the perfect oscillator because it does not use any number of bars in its calculation. It's based on statistics. It's based on extreme volatility over the last 20 days and comparing today's volatility to that. So it can be used in hundreds of different ways, including divergence trades for double tops, double bottoms, and pullbacks.